Welcome back to Gold Rush Reporter, your go-to channel for real, no-nonsense insights on gold and silver. I'm your analyst, and today we're diving deep into some recent moves in the precious metals market that most people aren't even aware of. If you think you know what's happening with gold and silver, think again. This week has exposed some massive shifts that could affect everyone from retail buyers to institutional investors. Let's start with a scene that you might have missed. A few weeks ago, enormous quantities of gold and silver suddenly hit the access market, and the timing couldn't have been worse. This wasn't a normal sell-off. It happened in a window between the New York market close and the Asian market open, when liquidity is almost non-existent. That's critical because in thin markets, even modest trades can trigger huge swings. Imagine this as a drive-by shooting in the market. Sudden, fast, and designed to cause panic. Why did it happen? It seems deliberate. Major financial institutions, including Morgan Stanley and Bank of America, were positioned to buy during this collapse. They swooped in and absorbed large amounts of metal just as prices were hammered down. This isn't speculation. These are moves tied to advice from top analysts like Michael Hartnett, who recently said that institutional investors should hold 20 to 25% of assets in gold. So, what looks like chaos on the surface is really a highly calculated strategy by the biggest players in the world. Now, consider the perspective of a normal trader or retail investor. You see the market drop, panic sets in, and the headlines scream, "Gold and silver are crashing." But here's the catch. The timing and execution ensured that prices would rebound quickly. Gold recovered, silver bounced back, and yet the public narrative remained focused on fear. The media often fails to report that these sales occurred in near zero liquidity periods, making the crash appear much worse than it really was. Even with these sudden drops, silver is still up over 65% this year, and gold has gained more than 50%. That's during one of the tightest monetary conditions we've seen in decades. Step back, and the picture becomes clear. The metals are showing resilience and strength, not weakness. What looks like manipulation or panic is often the system's attempt to reset sentiment, cover short positions, and create opportunities for those with the right strategy. There's another layer to this story: supply constraints and institutional demand. Physical gold and silver are being snapped up globally by central banks, commercial banks, and large investors. Tether, for example, has been using profits from stablecoins to acquire massive quantities of gold. This isn't just about speculation, it's about a silent rush for tangible assets in a world increasingly skeptical of paper currency. And while institutions quietly accumulate, retail investors face shortages and rising premiums. US mint products like gold buffaloes and silver eagles are harder to find, and premiums are spiking. This is a deliberate squeeze on supply designed to control distribution and influence market perception. Ordinary investors might panic at headlines, but understanding these moves is key to making informed decisions. When we dig deeper into the mechanics of what just happened, the picture gets even more fascinating. The crash you saw in gold and silver wasn't random. It was timed, and the players involved were highly strategic. European banks, including Scotiabank, were reportedly dumping large amounts of metal during periods of low liquidity, effectively transferring paper positions to American hands like Morgan Stanley and Bank of America. It wasn't a simple sell-off. It was a shift from weak to strong hands, from Europe to the US, and from paper to physical metal. This tells us a lot about market behavior. The drive-by nature of the sell-off was designed to trigger stop losses, create panic, and force weaker positions to liquidate. Yet, while retail traders and smaller investors were caught in the chaos. The largest institutions were absorbing those same metals at reduced prices. This is classic market strategy. Force the panic, pick up the undervalued assets, and wait for recovery. It's not a conspiracy. It's strategy, and it highlights the growing importance of physical possession over paper holdings. Supply is another crucial factor. Physical gold and silver are increasingly scarce in key markets. US mint products like Eagles and Buffaloes have become extremely difficult to obtain, and premiums are skyrocketing. A gold buffalo can cost around $300 over spot, and silver eagles are $7 to $9 above the metal price. That's not an accident. It's the market reflecting both scarcity and heightened demand from serious buyers. Meanwhile, Asia, especially China, is aggressively acquiring physical silver, often paying more than Western buyers. This creates a supply squeeze that will only intensify if current trends continue. Industrial demand adds another layer. Silver isn't just a precious metal. It's essential in technology and manufacturing. Its role in electronics, solar panels, and other industries makes its market small relative to demand. When institutional investors and governments are stockpiling silver, this already tight supply gets further constrained. The combination of industrial need, strategic buying, and restricted availability is a perfect storm that could push prices higher. It's also important to understand the behavior of paper markets. COMEX and similar exchanges often do not reflect the true supply and demand for physical metal. A small number of highly leveraged players can move paper prices dramatically, but they cannot affect actual physical resources indefinitely. When inventories, like registered COMEX silver, start to dwindle, it becomes impossible for these traders to maintain control. This is why we saw the dramatic price swings during the so-called midnight crash. It was a paper market maneuver, but physical demand was quietly climbing at the same time. This brings us to the bigger picture: resilience. Despite steep drops engineered by market forces, silver remains up over 65% this year and gold over 50%. That's an extraordinary performance during one of the most aggressive tightening cycles in decades. What this shows is that paper market volatility cannot mask the underlying strength and scarcity of real metal. Physical possession is becoming increasingly critical, and those who recognize these shifts are in a better position to navigate the market. In short, we're seeing a realignment of the global metals market. Strong hands are consolidating physical metal, supply is tightening, and the interplay between institutional strategy and retail panic is creating opportunities. This isn't just about price manipulation, it's about control, allocation, and the shift from paper to real assets. Now, let's turn our focus to the global influence on gold and silver markets. Beyond the US and Europe, major players like China and central banks are quietly shaping the direction of these metals. China has been directly engaging with miners, offering higher prices for silver than Western buyers, sometimes paying double, and even investing in infrastructure in Peru to secure supply. This isn't speculation. These are strategic moves to control resources and ensure access to physical metal. When the world's second largest silver producer tells you they're actively securing supply, it's a signal that scarcity is a real concern. Central banks, too, are playing a critical role. Recent reports show US commercial banks purchasing gold at unprecedented levels, sometimes months in advance of public reporting. Gold purchases in September alone jumped 79% month over month, reaching 39 tons. This is not casual accumulation, it's a coordinated effort to secure long-term physical holdings while simultaneously influencing market sentiment. When you combine this with Tether's massive purchases, including $13 billion worth of gold reported in their third quarter financial statement, the scale of institutional demand becomes clear. These are not retail players. They are liquidity-heavy institutions shaping both paper and physical markets. The so-called midnight crash we witnessed also makes more sense in this context. It wasn't a failure of the metals. It was an engineered opportunity. Large European institutions were selling into thin, illiquid markets, triggering stops and panic, only for American banks to scoop up real metal at a discount. The paper market was manipulated to create a temporary illusion of weakness, but the underlying story was accumulation and physical positioning. This is why silver and gold recovered so quickly after the initial crash. The fundamental demand had not changed. Physical scarcity is increasingly evident on a retail level as well. US mint products are scarce, and premiums are exploding. Silver eagles are costing far above spot, and gold buffaloes are nearly impossible to find. Meanwhile, Asia's appetite continues to grow, particularly in China and India, where gold and silver are both seen as a hedge against currency devaluation. Retail investors may see high premiums as a deterrent, but in reality, this is a reflection of the serious buying activity occurring at the top level. Industrial demand adds pressure as well. Silver's applications in solar panels, electronics, and medical devices ensure that supply remains tight relative to demand. Mining companies, particularly those focused on silver, are finding it increasingly difficult to locate large deposits. First Majestic, for example, is primarily silver-focused, but even their growth is constrained by limited available reserves. Much of global silver supply now comes as a byproduct of other mining operations, making it harder for any single entity to scale production quickly. This combination of industrial demand, institutional accumulation, and strategic global positioning creates a market that is fundamentally resilient. Despite short-term crashes and paper market volatility, the underlying value of physical gold and silver continues to grow. Investors who focus solely on paper prices are missing the bigger picture. Real scarcity, real demand, and strategic accumulation are the factors driving true long-term value. Now let's examine how these global and institutional dynamics translate into real opportunities and risks for retail investors. One key takeaway is that volatility in the paper market doesn't equal weakness in the physical market. The drive-by dumps we've seen, where enormous amounts of gold and silver hit thin markets overnight, were engineered to trigger algorithmic sell orders and shake out weak hands. But the smart money, the major banks, central banks, and institutions used those moments to accumulate physical metal at discounted prices. This means that what looks like chaos is often a calculated redistribution of real assets from weaker holders to stronger hands. Physical scarcity is becoming increasingly obvious at the retail level. US mint products, such as eagles and buffaloes, are nearly impossible to find without paying significant premiums. Premiums for silver eagles have risen over $7 to $9, and gold buffaloes command $300 or more above spot. This isn't random. It reflects the underlying global demand and strategic accumulation by major players. If you're waiting for a cheap entry in retail coins, you may be chasing a mirage. The real game is already happening at the institutional level. Meanwhile, Asia continues to drive demand, particularly China, which is directly purchasing large amounts of silver from global producers and offering premium prices to secure supply. Their strategy is simple: control supply, limit exports, and build a strategic reserve. Combine this with the Western banks accumulating gold, and the market is being reshaped quietly but fundamentally. Industrial demand adds another layer of pressure, especially for silver, which is critical for electronics, solar energy, and other technologies. Mining companies can't keep up with this pace, and new large deposits are increasingly difficult to find. This is why resilience is the key theme in today's gold and silver markets. Despite aggressive paper market manipulation, physical metal continues to be hoarded, demand remains strong, and retail scarcity is increasing. Investors who panic during midnight crashes miss the bigger picture. Those drops are opportunities for accumulation, not a sign that the bull market is over. Physical possession and understanding supply constraints are now more important than ever. The strategic moves by institutions and nations also reveal a larger trend. Gold and silver are no longer just assets. They are tools of policy and power. Eastern nations are using them to hedge against Western currency dominance, and Western institutions are quietly securing reserves to protect their portfolios. As retail investors, understanding this global chessboard gives you an edge. This isn't about quick profits. It's about positioning yourself where the real demand and scarcity exist. The lessons from the recent gold and silver movements are clear. Volatility is not weakness, and retail panic is an opportunity for smart accumulation. The paper market can be manipulated, but physical metal tells the real story. While overnight dumps might trigger algorithmic sell-offs, the major banks and central banks are quietly buying, holding, and controlling supply. This redistribution of assets from weaker hands to stronger hands is exactly what creates scarcity at the retail level. If you want to play smart, you need to think like an institution. For retail investors, the first priority is access to physical metal. US mint eagles and buffaloes are expensive and scarce, and premiums are rising steadily. That scarcity will continue as global players accumulate. Asia, particularly China, is aggressively securing silver directly from miners, offering top prices to ensure supply. European banks have also played a role in pushing metals into stronger hands. Understanding that this is a strategic game, not just a market trend, is key to navigating it. Physical possession matters far more than following daily price swings on COMEX or other paper markets. The scarcity isn't only about coins. Mining production is constrained, and new large deposits are difficult to find. Many silver mines are now producing primarily as a byproduct of gold or other metals. Supply will tighten further as institutional demand increases, particularly for silver, which has a small market cap relative to gold and massive industrial usage. This creates a situation where price suppression is increasingly difficult. Physical scarcity and demand will eventually dominate over paper market manipulation. Another takeaway is the evolving geopolitical role of gold and silver. Eastern nations are securing these metals as a hedge and as part of broader economic strategies, while Western institutions are accumulating quietly for portfolio protection. The game has shifted from speculation to strategic positioning. Retail investors who understand these trends, who monitor global buying, supply constraints, and geopolitical moves, will have a distinct advantage over those who react to panic selling or media noise. Ultimately, resilience is the theme. Despite manipulations, the bull run is intact. Silver is still up over 65% for the year, and gold over 50%. The market isn't broken. It's maturing, shifting, and rewarding those who hold physical metal and understand the bigger picture. Panic sales are opportunities. Scarcity is inevitable. And strategic accumulation at the right moments can secure both protection and long-term gains. So, as your Gold Rush reporter, my advice is simple. Focus on physical possession, understand the global moves, track scarcity and institutional accumulation, and don't be swayed by overnight chaos in the paper markets. Gold and silver remain the ultimate insurance against financial instability, and those who act with knowledge and patience will be the winners in the coming phase of the metals market. This concludes our breakdown of the recent gold and silver events and what they mean for investors at all levels. Keep following the channel for updates and insights into market movements, institutional strategies, and opportunities to secure your own position in these critical metals.